Let's talk about retirement income strategies. I'm going to give you 12 tactics for generating steady income in retirement. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How are you doing today? I hope you are doing fantastic. I'm doing marvelous if you were to ask me. If you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to talk to you about retirement income strategies. It's very important. We all know you worked all your life. You'll spend 40 years you'll spend 40 years grinding, and now you want to make sure you have enough cash to kind of chill during your golden years. Sometimes it doesn't happen, and a lot of Americans, according to the Social Security Administration, are forced nowadays to work in retirement. Think about it. You're 65, 7 years old, 75 years old. You got to wake up in the morning and go to work. That's not a good scenario. So let's change that here. So I'm going to give you 12 tactics for generating steady income in retirement. Number one, put your money in buckets. So basically what I mean here is that you have to diversify. You have to be very clear about where you're putting your money. And you have to, diversification means what? Diversification means that you are choosing different buckets to save your cash. And the buckets can comprise stocks, bonds, Social Security or a pension, REITs. REIT stands for Real Estate Investment Trust, ETFs, exchange traded funds, and so on and so forth. My point here is that you need to sort of diversify. Don't put all your eggs in the same basket. And please don't act all scary because of risk. Risk is all there. As long as you want to grow your money, you gotta be able to bear some kind of risk. But the idea here is to mitigate the risk by diversification and doing a proper allocation. Proper allocation means that you are actually spending money. You're actually investing rather based on your investment horizons and investment goals. So for example, if you're someone in your 40s or 50s, you're not going to go for highly volatile and risky assets such as stocks. You're probably going into funds or bond funds or just bonds. And the reverse is true if you are in your 20s. If you're in your 20s, you're not buying like a CD, a certificate of deposit that pays you a 0.5% at the end of every month, at the end of every year. Whereas you have 40 years, you have your whole life in front of you to invest and take reasonable risks. So put your money in buckets. Number two, manage your spending. If you're trying to generate a steady income in retirement, you got to be very careful about your spending. What I'm trying to say here is that if you want to avoid running out of money during retirement, the standard rule has been to withdraw 4% from your nest egg in the first year of retirement and use the inflation rate as a guide to adjust withdrawals in subsequent years. Very important. So for example, let's say you have 1 million. You can withdraw 40,000 in year one. So if the inflation rate clocks in at 2% in year two, your withdrawals grows by 2% or 40,800. That way you're able to always stay in the right ballpark. So manage your spending. Step number 3, when it comes to retirement income strategies, you want to protect against inflation. Now, we are lucky that we live in the United States, and the inflation is kind of I would say low. So it hovers around 2%, 2.1%. So that's kind of cool. So one way to make sure your next egg keeps up with the cost of living is to remain invested in stocks. So that can make for a bumpy ride over the short term, right? Especially if you're in your 40s or in your 50s. But over the long haul, stocks' steady upward trend makes them a go-to hedge against inflation. Let me give you an example. As measured by the S&P 500, stocks have returned an average annual rate of 10% for 9 decades. Folks, that's 9 decades. 9 with the big 9. 90 years. So over the next decade, investors are more likely to see an average annual return of 8% or less, or even less. But even if inflation reverts to its long-term historical norm of a little over 3%, guess what? That return still provides a healthy cushion. So that you want to protect against inflation by having some of your buckets into stocks and stock funds, stock mutual funds. Number 4, you want to get income from your investment. When we talk about generating steady income in retirement, you want to basically get You want to get invested in those tools and assets and vehicles that pay you. So if you need to boost your retirement paycheck to supplement Social Security and other sources of guaranteed income, or to even generate cash while you wait for delayed benefits to supercharge your Social Security, dividend paying stocks in a taxable portfolio should be high on your list. Very important, folks. Dividend paying stocks. You have something called the dividend aristocrats. I'm talking about the McDonald of the world, the AT&T, the Johnson and Johnson, the 3M, the Caterpillar, the Boeing. Those are companies that may not grow year over year like by 20% or 30% or 50% like a Tesla or Amazon, but guess what? They are paying you. They are dividend investments, right? Those blue chip stocks have yields of 2.5 to 4%, sometimes 8%. And by doing that, you're getting cash every year. You're getting cash not even every year. Actually, some of those dividends are being paid every quarter, every 6 months, or every 9 months. So it depends on the company. Now, if you're scared about buying into a single company, you can buy an ETF. You can buy a mutual fund of stocks. You can buy a mutual fund of stocks that allow you to get regular income. One thing you also need to do, and this is number 5, this is our fifth tactic for generating steady income in retirement, is you can delay Social Security benefits. So you might not think of Social Security as an inflation fighter, but for many people, it will be their only stream of income with an automatic cost of living adjustment. That's what's called COLA. So the COLA is not that high, really, honestly. COLA means that they are actually just increasing a little bit your Social Security figures every year. COLA is at as of 2020 around 2.5%. That's not a lot. More than 45% of people take Social Security retirement benefits as early as they can at age 62. So for those who have taken early retirement, perhaps because of poor health, this often makes sense. But grabbing benefits early comes at a steep cost. Think about it. Because if you claim Social Security at age 62, your benefits will be reduced by as much as 30% compared with delaying until full retirement age, currently 66, but gradually rising to age 67. This is why you want to delay Social Security benefits. Tip number 6, you want to earn extra income. You want to be in the mindset of someone who is working. I'm not asking you to work full-time after working full-time for 45 years. Hello? No. My point here is that you want to have a part-time job during retirement. And this is not just for the money. It's also good for you metabolically. You got to stay active. Why do you think all our senators and congressmen and congresswomen, politicians in general, they are like way older? We have presidents. Our current president is over 75 years old, or over 70 years old rather. My point here is that if those politicians are working late in their lifetimes, there has to be a reason why. They gotta stay active. So you also have to stay active. So you want to learn to earn extra income. Learning to earn extra income doesn't mean that you have to go to work from 9 to 5. You can actually make money from home. Nowadays we have the internet. Thanks to the internet, there are a lot of opportunities on the internet to earn some extra cash. You can have a consulting company. You can do some coaching on the side. You can mentor. You can tutor. You can do a lot of stuff. I'll be right back. Right after this, don't go anywhere. Welcome back, folks, to another edition of Sweetie Q. We are also having a conversation here around retirement income strategies, and I'm giving you 12 tactics for generating steady income during retirement. Number 7, buy an annuity. By the way, folks, if you love the content's clarity and quality so far, please consider subscribing to our channel and turn on the notification bell so you can be informed in real time whenever we drop a new show. And please like this content, share, and comment. Buy an annuity. An annuity is kind of cool. When you buy an immediate annuity, you give an insurance company a lump sum in exchange for a monthly check, usually for life. You can buy an annuity that has survivor benefits so that it will continue to pay your spouse after you die. but you pay for that protection by accepting smaller monthly payouts. So another option is what's called a deferred income annuity. So the way it works is that you will purchase the annuity when you are in your 50s or 60s, but the payments don't start for at least 10 years. So the longer you wait, the bigger the payouts. Of course, if you die before a payment starts, you get nothing unless you opt for a return of premium or survivor benefits. So these products are often referred to as longevity insurance because they will protect you from the risk of outliving your savings. A relatively new type of deferred income annuity, it's called a qualified longevity annuity contract, a QLAC, and this offers a tax benefits for retirees who have a lot of money in tax-deferred retirement accounts. So you can invest up to 25% of your traditional IRA or 401k plan, or $125,000, whichever is less, in a QLAC without taking required minimum distributions on that money when you turn 70 and a half. So to qualify though for this special tax treatment, your payments must begin no later than age 85. You can also, this is tip number 8, you want to minimize taxes. Now, minimize taxes means you can actually enlist the help of a tax accountant. You can have either an EA or an enrolled agent, or a CPA, a certified public accountant, or even a legal attorney, a fiscal attorney rather. So to get the most out of your retirement savings, you need to shield as much as possible from Uncle Sam. Again, now here I'm talking about legal ways, legitimate ways, things you want to do things legitimately. Fortunately, there are plenty of legal ways to lower your tax bill, but they require careful planning and a thorough understanding of how your different retirement accounts are taxed. Here I'm talking about IRA. We've spent a lot of time talking about IRAs and Roth IRAs, so you might want to double check our series on the retirement planning, and you can understand everything about required minimum distributions, RMDs, and how to minimize your taxes. The next thing you want to do if you want to generate steady income in retirement is to manage your pension. So at a time when defined benefit plans are becoming as rare as copywriters, you want to consider yourself fortunate if you have a traditional pension to manage. Even so, the decision that you make about how you take your pension payout could have a significant impact on the amount of income you receive. And this is why you got to be very careful here, folks. One of the first decisions you'll probably have to make is whether to take your pension as a lump sum or as a lifetime payout. So a lump sum can make sense if you have other assets such as life insurance or a sizable investment portfolio, and if you are comfortable managing your money or paying someone else to do it for you. You'll have more flexibilities to take withdrawals, and your investments could grow faster than the rate of inflation. When you don't spend, what you don't spend will go to your heirs. A lifetime payout, however, offers protection against market downturns, and you won't have to worry about outliving your money. This is kind of cool too. So you'll probably also get a higher payout from your former employer than you could get by taking a lump sum and buying an annuity from an insurer. So consider longevity when deciding how to structure your lifetime payout. One thing we have found is that married couples have a couple of basic options for the payments: single life or joint and survivor. So taking the single life payments will deliver bigger monthly payments, but your pension will end when you die. By law though, remember, if you're married, you must obtain your spouse's consent before taking this option. So with the joint and survivor alternative, payments will be smaller, but they will continue as long as you and or spouse is alive. You can also tap into permanent life insurance. That's number 10. So most of us buy life insurance to provide financial security for our loved ones after we're gone. But check this out. A permanent life insurance policy could provide a valuable source of income while you're still around to enjoy it. So a permanent life insurance policy has two components. So you have the death benefits, which is the amount that will be paid to your beneficiaries when you die, and the cash value, which is actually a tax-advantaged savings account that is funded by a portion of your premiums. So with whole life and universal life, the insurance company usually promises that a minimal level of interest will be paid to you after insurance costs and expenses are deducted. So that, and so that's for whole life, and universal life. Now, with variable life insurance policies, you choose the investments and may not get a guarantee. The great thing here is that you can withdraw your basis, so the amount in the cash flow account you've paid in premiums tax-free. And this, if you think about it, could provide a cash cushion in case, say, the stock market takes a 2008 style downturn or a 2020 COVID-19 style downturn, and you want to give your portfolio a chance to recover. So remember that when you can also borrow against your policy. So when you do, you're not taking withdrawals from your account that will pay back later, as is the case with a 401k plan, right? Rather, the insurer is lending you money and using your policy as collateral. So unless you pay the interest out of pocket, it will be added to the loan balance. And if the balance exceeds the policy's cash value, the policy could lapse, and you will owe taxes on the amount of the cash value, including loans that exceeds the premiums you paid. Tactic number 11. If you want to generate steady income in retirement, plan for healthcare costs. Folks, we all know what happens, right? If you are in your 60s, you are retired, medical conditions might crop up here and there are a lot of things you need to think about. So you need to kind of have that in mind. Fidelity Investments estimates, for example, that the average 65-year-old couple retiring now in 2020 will need about $260,000 to pay out-of-pocket healthcare costs. Here I'm talking about deductibles, Medicare premiums over the rest of their lives. So that does not include long-term care, which can be a major budget buster. So there are various ways when it comes to paying this future medical bills. One tax-friendly way is something called HSA, a health savings account. So as long as you have an eligible high deductible health insurance policy, you can contribute to an HSA either through your employer or on your own, but you can no longer contribute after you've signed up for Medicare, though. That's kind of important. And the great thing about HSA is that it has a trifecta of fiscal advantages. So you contribute money on a pre-tax basis to the account. Money in the account grows tax deferred, and withdrawals are tax-free if used to pay medical expenses either today or when you're retired. So you want to contribute as much as you can to the account and pay current medical bills out of pocket. This way, the money in the account has time to grow. Years from now, you can use your HSA funds to reimburse yourself for medical bills you're paying today. And the last thing you want to think about when it comes to generating steady income in retirement is to move to a cheaper location. I mean, that's kind of important. I'm talking about not just in terms of geography, but also in terms of residence. So downsizing to a smaller place, particularly after the kids are launched, is a common way to lower housing costs and stay close to family. So if you live in a highly appreciated home, selling can free up large sums that can be used to wipe out debts, add to a nest egg, or pay future long-term costs. So married couple can protect up to $500,000 in profit from the sale of a house from capital gains tax. Singles can shelter half that amount. But for a move to become a financial game changer and significantly lower living costs, you want to consider putting down roots in a state where housing and living expenses are cheaper. This is very important. This is what all experts are saying, right? So you want to think about that. So you can go to the website of the U.S. Census Bureau. So Census, census.gov, to find out more about the states where cost of living is low, and those states that you really have to stay away from where the cost of living is high. All right, folks. So this was it. This is it for today. And let's quickly recap to this conversation. I was giving you 12 tactics for generating steady income in retirement. So I was telling you to move to a cheaper location, plan for healthcare costs, tap permanent life insurance, manage your pension, minimize taxes, buy an annuity, earn extra income, delay Social Security benefits, get income from your investments, protect against inflation, manage your spending, and put your money in buckets. I will see you next time. Thank you so much for listening. And until next time, remember, stay marvelous.